Again, welcome to the webinar. My name is Deborah Gallant. I run these deep dive programs for entrepreneurs forever every month. This month's topic is on cash flow, probably cash cycle would have been a better word, but talking about line of credit. And if you don't know the difference between those two, I probably didn't before Christine schooled me. So you're going to learn a lot today. What we're going to do is introduce ourselves and our program. I always talk about upcoming programs at the beginning because if I don't, I forget to come back. Then we'll do the presentation and then open Q&A. We do not record the Q&A. So if you want to, get down and dirty and ask your real questions without worrying that it's recorded for posterity, that's the time to do it. However, if you have questions as we go along, you can either use the raise your hand function or type in the chat and I'll try to monitor it the best I can. We get a lot out of these programs and I'm just delighted you're here with us today. If you don't already know about Entrepreneurs Forever, we are a program, a nonprofit that has as a mission to empower all small business owners to grow thriving businesses, to sustain their families and support their communities. We do that mostly with monthly peer group meetings. I see a couple of our members and I even see one of our facilitators. Hello, Greg. Our upcoming programs, as I said, I try to make sure you know about them before I launch in, because if I don't do that, I don't get back to it. Next month, I have an attorney coming to talk about contracts in your small business. I have a special program we're doing on Friday, June 13th called Own Your Success, Building Confidence for Small Business Owners. If you are ever suffering from imposter syndrome, this is the one for you. I have a special guest presenter, April Jackson, and that one's on a Friday morning. And then our deep dive in June will be on the new rules of search. And here's what I'll say is if you've noticed that when you do a search on Google and it doesn't look like it used to, that has implications for your small business. AI is intermediating your experience with their search engine and your business may not be being found. So we have a search expert coming in to help us understand the new rules of search, and that's in June. And all of those are things that you can sign up for on our website. So this one's an important one, especially because I have a financial advisor here with us today. This presentation does not take the place of professional advice from your own paid advisors. It's meant to help you understand things. But if you have specifics or you want to know, would I qualify for an LOC? Christine is not going to be able to tell you that for sure. And she certainly isn't going to commit to getting you one. But she can give you her opinion or say, gee, maybe you need to think about this or need to think about that. But you really need to talk to your own advisors. So I'm going to be, I'm going to be quiet here for a moment and let our guest presenter, Christine, tell you about herself and all of her amazing credentials before we dive into the program. So Christine, you're up.
Okay, thank you, Deborah. And it's interesting that you and I have talked many times, and this is the first time I knew you weren't in Pittsburgh. Had no idea. Welcome, everybody. I can't see you, but I'm very glad you're here. Greg and Laura, thank you for coming. So I am, my background, I majored in engineering at Carnegie Mellon, and I have a master's in finance, and I'm a certified commercial lender and cash manager, and I'm a 3-time founder. So I taught a course. I was an instructor of corporate finance for 30 years at the Tepper School at CMU, advised McGinnis Ventures companies that are early stage spinning out of CMU. And I was the founding co-chair of the investment committee of an angel investment fund here in Pittsburgh called Next Act. So my expertise is in understanding businesses, understanding cash flow, which leads to raising debt and equity capital for early stage companies. So that's where my expertise lies.
And Christine was suggested to me by a couple of people, including Greg, as a terrific presenter. My biggest issue with dealing with this with Christine is there's so much we could have covered, and we tried to really narrow it down to subject matter we could cover in the about 45 minutes to an hour of the presentation. And as I said, again, at the end of the presentation part, we'll stop the recording and have an open conversation, and hopefully get your questions answered. So here's what Christine's going to try to cover. You want to talk about this?
Sure. So we're going to talk about the cash cycle. So what is a cash cycle? We're going to look at a sample company's cash cycle so that you have a very firm idea of how you evaluate your cash cycle. We talk about a line of credit and why every business needs one to cover their cash cycle. We're going to talk a little bit about what you need to do to obtain a line of credit from a bank or a CDFI, and I'll answer your questions at the end, and I'm happy to do that. So, and really, I'd like to spend as much time as I can on your questions. So I'll try to walk through the slides, but if you have questions while I'm going through, please don't hold them. Just ask as we go. Okay.
And I will be sending out the deck as well as a handout, which I'll attach in the chat in a moment. And there's also a sample pro forma that is a little daunting when you first see it, but we put it together in case anybody feels like they needed a sample to see what that looked like. So we're going to get rolling.
Thank you. All right. So let's talk about what a cash cycle is. So it measures the time it takes a company to go from the purchase of raw materials. So if you make a product, you might have raw materials, inventory, labor costs, utilities, rent, that kind of thing. But if you are a service company, you're going to have payroll, and you're going to have utilities, and you're going to have expenses for computer equipment and cloud storage. So it measures the time and the money it takes to go from obtaining the materials to produce your product or service until you sell that product or service to a customer and get the money for the sale in your account. So if you buy materials or have, say, payroll every 2 weeks, you have a product that you're making or a service you're providing, you sell that to a customer, and you give that customer 30 days to pay you, maybe, if it's a business to business model, then the cash cycle might be 90 days, could be 60 days to produce the product and do your marketing and obtain your customer and convince the customer to sell, to buy from you. And then once they buy, you give them 30 days to pay you. So you could, let's say that your cash cycle might be 90 days, could be longer, but we're going to talk about how to measure it.
Christine, I thought I needed to leave the screen sharing for a minute so I can go get the attachment to give them. But I thought since we're a relatively small group, folks might want to share what their business is with you so that, for instance, Laura is, I know, warm return with composting, but telling the group what their business is so that you can use those as examples might be a valuable use of this time. So Laura, you want to go first, and then others can just tell us about their business if they would like.
Sure. Yeah. Thank you. Christine, it's fantastic to see you. When I saw this was happening, I was like, I got to do this. I love Christine. She is extremely knowledgeable. She actually helped me set up my chart of accounts when Worm Return was just a baby. Worm Return is a composting company. We are in our 8th year of business. Cash flow is our biggest problem. Greg, my facilitator, knows that's what one of my peers and I talk about. What's it been the last 3 months? We talk about cash flow issues. And I recently, I work with a lot of small businesses as well. My background's in the restaurant industry. I was a server for 25 years, and I've always been good with customer service. And so I was able to speak to one of my bigger clients and say, look, I struggle with cash flow. Could we start billing you every 2 weeks instead of every month? And she goes, oh my gosh, that would be easier for me. And what that has done to just keep money coming in. So I'm really excited to hear what goes on here today.
Good. Great. Good to
Thank
see
you.
Uh-huh.
I see 2 Chris's. If one of the Chris's would like to introduce themselves, either one.
Chris, you with the R, I'm sorry, is it Rojic?
Rojic.
Rojic? Okay,
Yes.
you were first in. What is your business?
I am a custom picture framer in Sharpsburg, and you have actually got stuff
I
framed.
have. I love your business. Oh my word. I love, oh my good. I'm bringing more down. Yes. Great to see you. Okay. And Chris Kreitzer?
Yes, I operate Kreitzer Communication, which is a marketing communication and fundraising company for nonprofits, small businesses, and community-based organizations.
Wonderful. Okay. Super. Do you have any employees?
I use independent contractors.
Okay. Super. Wonderful. Okay. Alicia Volci? Volci? Vol-
Hi, I'm Alicia Volsi.
Thank you.
And my business is Studio Volsi. So I do design and real estate development. So it's essentially two companies, outwardly facing it, it appears to be one, but it's essentially two businesses where I operate by doing client-based design work. And so we're talking mainly extensive interior design work. And then on the real estate development side, those are properties that we purchase and then invest in.
Do you purchase them so that you rent them, or do you purchase them so that you resell them, or?
So we don't do any selling. Thus far, everything that we've done has been something that we purchase and then rent. And then right now we're working on our flagship commercial real estate project, which is in the Hill District. And that's renovation of a it's about 9,000 square feet, a warehouse that we're turning into a commercial redevelopment project. So just looking forward to talking to you all today. I do have a line of credit for that, but would like to maybe learn more about how I could potentially do something like this for my the client base side of my business.
Super. And we also, Alicia, we'll also talk about whether as your business grows, your line of credit has to change. And if your line of credit is keeping up with the growth of your business. So we could talk about that too. Okay, let's see. Sandra Gilliard.
Sandra Gilliard.
Thank you. Okay.
Hi, how are you? Glad to be here. I'm interested to learn everything I can. I'm Sandra Gilliard, based in Philadelphia, Pennsylvania, and I have a training and coaching service for women, specifically leadership development from a feminine perspective. And I am interested to see how I have service-based, as I said, so a lot of money go into providing and getting ready to facilitate workshops and cohorts, and sometimes they're like 3 months.
Yep.
And particularly the ones I do for organizations, and it's a long up ramp, and so I'm just trying to figure out how do I navigate that.
Yeah. So you would set up an event and you would have to put all the deposits and things down, and then when you engage your attendees, then they pay you later.
Not necessarily. I usually do group events for companies. And so I expend everything. I get the workbooks, everything ready, and I'll do it. And then my training program may be 3 months because it's training and coaching. And then at the end of that, we have usually the contracts are for the end of the deliverable, but it normally takes about 30 to 60 days for the processing of the payments to come.
You bet. I know those big companies, they're thinkers. I agree.
So I
Okay.
spend a lot of time with a lot of invoices on the books and not cash coming in.
Well, that's exactly what we're going to talk about. You're the perfect customer for this.
Well,
Okay.
Gloria typed in that she is in a B2B consulting business, so I guess she can talk. Brianna and Juan Manuel, we haven't heard from you. Brianna?
Yes. And one more too.
Hi, everybody. I'm Brianna. Brianna's Mobile Workshop is our company. We're a queer-owned and operated company doing work for people in the community and allies. We do anything from additions, interior, exterior work, all the way down to just simple repairs for people who really can't afford to, get those sorts of things done. So
you're contracting.
Contracting and repair. Yeah, we do a lot of contracting, but we also go into with a lot of people frown upon handiwork.
Great. Wonderful. Oh, you're a blessing to many, I'm sure. So do you have employees, or are they independent contractors, or?
Brianna, do you have employees?
Okay, so I lost you for a second there. Yeah, I have three employees currently.
Wonderful. Okay, thank you very much. Great. Okay,
Mhm.
Gloria Ware.
Gloria said she typed it in that she's B2B consulting.
Super.
Juan Manuel,
Juan.
Hello, everybody. I'm Juan Manuel Jauregui, Juan for short. Our firm is a consulting firm in economics, finance, and management. I'm a former senior economist at the International Monetary Fund.
Ah,
We do a lot of economics, a lot of international finance, international trade, advice to investors, with a lot of analysis for fixed income, investment funds, banks, big government agencies, but we also do strategic management, and we also do consulting on individual businesses that sometimes need to understand the environment and decide what to do on a multiplicity of things, from marketing to finance or operations. So it's a very small organization based only on a network approach of independent consultants.
okay. Thank you very much. You're probably a very busy man right now.
all right. Thank you for that background. I think that will help Christine a lot as we move forward into this. Let's go. Oops, back into the deck. All right, we were here. There you go.
Wonderful. Okay. We're going to use a hypothetical firm called Acme Manufacturing Company, a manufacturer of organic beauty products, to illustrate the cash cycle. Now, this is just an example of a manufacturer, but the ideas we talk about are transferable to service businesses, contracting businesses. But again, free to ask questions as we go along. So Acme needs to buy materials, make payroll, and manufacture their products. So that's time in their factory or in their work space with utilities and rent before they can sell their products and collect the payments. Okay. So this is sort of a 5-step visual of their cash cycle. So they purchase raw materials, the ingredients they need to create their products. They do the manufacturing, and while they're manufacturing, they have labor costs, rent, and they could have things like, if they 3D print, they might have the materials for 3D printing as they're going along. They could have expense for any kind of consumable product that enters into the manufacture of their product. Then, after they manufacture their products, they put them into inventory. So this could be people that are in retail, that have a retail store. It could be wholesalers who distribute products to other folks. And it could be folks that just have a virtual store where they have a e-commerce website and they're putting their inventory somewhere. Okay, then products their products are purchased. So their products could be purchased at a retail outlet. They could be purchased online. They could be purchased by, in the case of a distributor, by a retailer who will then proceed to resell them to their retail customers. Any way you do it, when products are sold, there's a lot of ways that people pay. So let's say that you own a business that does beautiful custom picture frames. And when people come in, so they place their order, you get their images or their whatever they're going to have framed. You take that, you then have the framing materials, you order them or you have them in your inventory, you make the picture, with the glass, and you package the whole thing. You have folks doing that work. And then the person comes in to pick it up. And when they pick it up, they either pay with a credit card or write a check or give you cash. Now, in that case, they're paying right there. You have the beautiful framed picture. You're not going to give it to them unless they pay. And even if they pay with a credit card, you're going to get that money the next day. So your cash cycle ends right there. So depending on how long or how much your backlog is, how long it takes you to finish the product, your cash cycle is going to end the day they pick it up. Now, with a manufacturer, if it's a business to business sale, businesses give one another terms. Those terms could be due on receipt, pay me as soon as you get the stuff. It could be 210 net 30. You get a 2% discount if you pay me in 10 days. If you pay me in 30, you pay the full price. You could give them 60-day terms. Sometimes really big companies that are selling to small companies. So when we're small and they're big, they dictate the terms and say, if we're PNC or we're UPMC, we don't pay you for 90 days. And we decide, not you. Even if your invoice says due in 30, they just don't pay it for 90 days. Sometimes they do that. And you have a choice. You can either try to enforce your terms or you can simply not do business with them. Most people want to do business with the big boys, and so they just swallow hard and accept their terms. But it does put pressure on your cash flow. Okay, so that's sort of a visual. In this case, for this particular Acme Manufacturing, to make their product, they have raw materials that cost $25,000 and packaging that costs $40,000. So their direct manufacturing costs are $65,000. Direct, meaning costs without which they cannot make their product. Okay. Then we have operating costs. Direct costs are referred to as above the line. They are part of cost of goods sold. Operating costs are below the line. They're part of sales, general, and administrative costs. So these costs, rent, utilities, payroll, office expenses like, printer ink and envelopes, whatever. Those things, rent, you're going to pay rent whether you sell a product or not. You're going to pay your utilities as long as you have a lease on your space. You've got to pay those whether you sell or not. So these are indirect costs. And for Acme Manufacturing, those total $20,000 per month. Okay, so here's another visual of a cash cycle. So they put out $65,000 in materials and $20,000 in overhead in early January. They start the year with $25,000 cash on hand. They have every month they have $20,000 in overhead. So in February they incur that again. So they make products and sell products and get payment. They receive payment for product sales in March. So how much cash do they need? They have $105,000 is the cash need. Can we go back one slide so we can see where that 105 comes from? Okay, so we've got 65 plus 40, 20 and 20 gives us the 105. Okay, so they need 105 in cash. They started with 25,000, so they need another 80,000. So where does it come from? Usually that cash need, which is, again, it's known as funding your cash cycle, is a line of credit is what's used to do that. So a line of credit is different than a term loan because you can borrow, repay, and borrow again. As long as you are meeting the requirements, the conditions by which a bank or a community development financial institution has lent you money for a line of credit, as long as you do that is yours to use as you see fit, up to the limit of the line of credit, and payments on the line are interest only. So it's not like a term loan where you have a principal and interest payment. It's interest only. Now, okay, yeah, let's go on to the next slide. Yeah, I want to get ahead of myself. So how do you use a line? You take what you need only when you need it. How do I access the line? When you establish a line of credit with a financial institution, either a bank, there are actually secondary financiers that do this as well. And then there are community development financial institutions like Bridgeway Capital is one in our community. and we have someone here from Philadelphia. I'm sure there are community development financial institutions out there as well you're probably familiar with. They set the terms, they set the interest, and they set the conditions by which you can borrow. Typically, you have an operating account with the same financial institution who grants you a line of credit. And when you need to draw on the line, you either go through an online portal and say, I would like 50,000, and that 50,000 is then deposited into your operating account for you to use. Or you might have to make a phone call to someone and say, I'd like some money on my line. I have availability. Please deposit it into my account. And they do so within the next day. But typically, you can have access to that money very quickly. How do I repay it? You repay it according to the terms of your loan agreement. But typically, you have to pay interest on a monthly basis. You get one bill a month for the interest. The terms depend on the financial institution, and so do the rates. So the higher your credit rating, so you have a credit rating and your business has a credit rating, in case you didn't know that, you do. And they will look at both. But for those of us that are small business owners, they're going to look at our personal credit. If it's very good, we'll get a better rate. We'll get a larger line. If it's not good, we may not be able to get a line. And that's when we go to, say, Bridgeway Capital. They are going to take more risk than a commercial bank is going to take, because their mission in life is to help businesses like ours succeed. And so they're willing to take more risk. With risk and return are linked. More risk, higher rate.
Does a line of credit work against your credit rating? Is it like a debt, even if you're not drawing on it all the time?
So the line of credit, if granted, will be granted in the name of your business, not you personally. You may be asked to sign a personal guarantee for it, but typically I do not think that line of credit payments are reported to credit bureaus, if that's what you're asking.
Yes, that was what
No.
I was asking.
I don't believe they do. I could be wrong, but it has not been my experience that happens. Is this where we are then?
Yep.
Okay. So interest only, you can borrow on it, repay and reborrow. Now, how would you typically use one? Well, let's go to Acme Manufacturing. They have this $80,000 deficit. They need this $80,000 in cash to cover their cash cycle. Once they sell their products, they get cash. And because they're a going concern and they're still in business, they get more cash than it costs them to make their products. And that's their margin. And when they get that cash, they pay down the line. And then to make more product, they may borrow again. It depends on, if they're a growing company, they're going to continue to borrow. If they are extremely profitable, they may not need it. I have clients that have lines of credit that they don't access at all unless they have a special project, because they're enormously profitable and don't need to use it on a regular basis. That doesn't mean that you couldn't be a very healthy business and use a line of credit. Most healthy businesses have lines of credit and they use them. Okay, there is something called a clearance provision in lines of credit. So I was a banker for 15 years back in the 80s and 90s, early 90s. And at that time, lines of credit almost always had a clearance provision. What that meant was, once a year for at least 24 hours, some longer, up to 2 weeks, you had to have a zero balance on your line of credit. Why? To ensure that you're using the line of credit to cover your cash cycle, not to buy something else. So you are not supposed to use your line of credit, this revolving line of credit, to, say, buy a big piece of equipment, or to fund a new business. That's not what it's for. It is to cover the cash cycle of your existing business. the one for which the financial institution lent you, created the line. So by making you clear the line once a year, that ensured that as your cash came in, you're paying down the line and you're reborrowing, but you're paying it down again. And since you're profitable, it was no problem to have a clearance every year. Now, today, a lot of banks no longer require a clearance provision, but I wanted to make sure you know what that is. And when you endeavor to open a line of credit, that you read your documents and look for that clause of a clearance provision, principal clearance.
So this is really to fund operations. And if you wanted to go buy that piece of equipment, that's a different financial transaction. You need to go and get approved and financed. And they'll also require all of this financial documentation. But a line of credit is very specifically about funding ongoing growth and operations.
Correct. If you wanted to buy a piece of equipment, then you either get a term loan for the piece of equipment or you do an equipment lease. There's a lot of ways to finance equipment, but that is not what we're talking about today. We're talking about lines of credit to fund your cash cycle. A line of credit is also something that, let's say that you, like I'm sure all of you, have very profitable businesses, and you're thinking, well, maybe I don't actually need a line today. I have my customers pay well, and everything seems to be going well. Well, I would highly recommend that you get a line of credit when you don't need one, because it's very inexpensive to have. You don't pay for anything you don't borrow. But if something should happen, it is very nice to have a line of credit sitting there knowing that you have access to cash should you need it without having to ask anybody's permission. And it is not quick to get a line of credit. Typically, it could take 2 months to secure one, depending. It could sometimes it takes longer, depending on who's doing it and who you're working with. So very good idea to begin the process before you really need the cash. Okay, so how much should my line of credit be? We evaluate the line of credit based on your cash cycle. So the larger your cash cycle, the larger your line. So a line of credit is tied to accounts receivable and inventory. Now, if you have a service business, you don't have inventory. You only have accounts receivable. If you are, let's say you're a company that everyone pays you immediately, you might not even have receivables. In that case, your line of credit would be tied to a pro forma that projects future cash receipts from ongoing business. So this example we're using is for Acme Manufacturing, and in their case, they do have inventory and they do have receivables. So the bank would look at their receivables over the last at least 18 months. They would get a sense for how much their receivables are. So if you're a growing business, your receivables are going to be increasing every month or at least every quarter. And so your line of credit you would want to have tied to your latest receivables. Inventory, if it's managed well, should be turning. So it should not be building over time. It should be, it could increase in value as you grow, but it should not become excessive, because that would indicate that you're not selling as much as you're making. And that's a red flag. But let's just say in this case, this is a successful, well-turning business. Banks are going to look at the value of your inventory and the value of your receivables, and they will lend you somewhere between 75 to 80% of your accounts receivable and 50% of your inventory. So they add the two of them up. So in this case, this company, Acme Manufacturing, had $80,000 in accounts receivable, so they could have a line of credit of up to $60,000. They have $100,000 in inventory, which gives them another $50,000. So the two added together would be a $110,000 line of credit.
And that would be the total amount maximum, but then they could draw only what they need, correct?
Correct. So they would go to a bank or a financial institution and say, I would like to borrow $110,000. I would like a line of credit of 110,000. And if they were able to secure it, they would have no problem borrowing the 80,000 they need to cover the cash cycle we looked at.
Gotcha.
Okay, so the line would be used to pay invoices for materials, to make payroll, to pay utilities, to pay rent, whatever they need, while they're waiting for their customers to pay them for the things that they sold them. Okay, right. So we've just covered a lot of big subjects. Does anybody have any questions?
Yeah, I do. It's Brianna. I'm curious, you say accounts receivable, when you're looking at the amount that's coming in, are you talking about in a 3-month span or an 18-month span? Like what time
That's a
frame is
good
that?
question. That's a very good question. We're looking at them every month. What are they monthly?
And it's 80% of your monthly income.
Of your month, yeah, of your
Receivable.
monthly receivables, correct. Yeah, so we would bracket. That's a really good question. So businesses that are well positioned to get a line of credit close their financials every month, meaning they actually bracket their financial performance from the first to the end of the month, and they create a balance sheet and an income statement and a cash flow for each month. And that's what we're looking at. If we were to pull a report from an accounting system by month for the last 12 months, we would show on the income statement revenue by month, cost of goods sold by month, sales, general, and administrative expenses by month, gross and net margin by month. On the balance sheet, we would show accounts receivable and inventory as well as cash position every month. And it's the average of those that we would be looking at for a line of credit. That's a great question. Thank you for asking. Anybody else?
Go ahead, Laura.
Yes, if I may. So, Christine, this is something I recently learned when we were in the Penn's boot camp. You know, get a line of credit before you need the line of credit. And, you know, if I would have done that in 2018, my credit score was perfect. I was still working a job. Now I'm in a position where, like, it looks awful. How is there a way to secure a line of credit when it's like kind of too late?
No, it's never too late. And I have this question all the time. My clients are always saying, I'm never going to get a line of credit because my credit's terrible. And
All right, here, I'm going to ask you, can we leave this conversation to the end? Because I would prefer it not be taped, so Laura can tell us the whole story and you can give us really good advice.
Okay.
But I think it's a great question, Laura, and I think that you're a case in point. Get one before you think you need it, because it will be really helpful as another tool in your management toolbox. And now the next part of this is a little daunting, I'll admit, because I helped Christine put all this together. You have to have your ducks in a row. You need to have your financial statements in order. So the next part she's going to talk about are what you need to have. And then we'll come back, turn the recording off, and talk you through your problem, Laura, because I think that's a great one to talk about.
Okay, so we have a couple of questions in the chat.
Okay.
So let's take a, can you look at those, please? And we
Yeah,
can, because they're good questions.
well, Gloria's recommending it. Are all accounts receivable counted? And how does receivables factoring differ from a line of credit?
That's great. Those are great questions. Okay, that's super. So are all receivables counted? No. Only the ones that are 60, like if your terms are 30 days, we only look at 60 days or less. If people have owed you money for 90, 120 days, 180 days, we don't count them. They're not part of your borrowing base because they may become uncollectible. So that's a great question. In terms of factoring is the same concept, but for higher risk businesses.
So maybe you need to explain what factoring is, and everyone might not know.
Factoring is a financier. It could be a bank that does asset-based lending, and not all banks do that. Or it could be a secondary lender. There are a lot of them today. ARF Financial is one. There's a lot of them. I think my inbox gets 10 requests a week from private people that just have a lot of money and set up their own. They're willing to lend. They are not banks or financial institutions, because in order to be a bank, you have to both take deposits and make loans. They're only making loans, so they're not a bank. They're a private lender, and they make their own rules, and they're very expensive. But if you need cash for your business and that is the only way to get it, that's one way to do it. So they come in, they look at your receivables, and they say, we will lend you X% of your receivables. That's why it's called factoring. It's a factor times your receivables. Gloria, does that answer your question? Questions?
If we need to go into it more, we can, but let's get into some of the documentation so we can get to the fun part.
Okay, super. To apply for financing through banks or CDFI. Now, I want to say one thing before we go on. All banks are not created equal when it comes to financing for small business. There are banks that are much more well-suited to lending to smaller organizations, and they do it a lot. And it pays to do your research on who does the most small business lending in our state. And that's information you can find out pretty easily. The Small Business Administration has a program whereby a portion of the federal budget every year is apportioned to states, and then it is granted to the in Pennsylvania we have the Ben Franklin Technology Partners. Here we have Innovation Works, but we also have SBA lenders, and the part of the SBA financing package is to guarantee loans to small businesses and allow banks to take more risks to lend to smaller businesses than you could get on your own. So you sort of are borrowing in tandem with the Small Business Administration, because as a nation, we really want all of you to succeed. It's good for all of us. 70% of the American economy is small business, and we need to encourage all of these businesses to succeed, and we do. So please do not think that there's no way you're going to get a line. There's a lot of ways that you could potentially get a line. All right, so to get one, you need a pro forma. And what that is it's a forward look at your financial statements. So there's two disciplines that we're talking about today, actually three, but so accounting and finance. Does anybody know the difference in a sentence? And if you don't feel like
oh, Greg, come on, you know it.
If you don't feel like answering it, I'll answer it, but if someone wants to, go ahead.
I defer to the expert. Thanks for
Okay.
the invitation, though, Deborah.
Sure. Okay. So accounting tells you what happened last week, last month, last quarter, last year, 2 years ago. It's already happened. Correct. Thank you. Thank you, Laura. Right. Finance is the future. So finance builds on an accounting platform to say, all right, given that this is what we've done in the last 3 years, what do we think we're going to do in the next 3? And so it's a hypothesis, not a guess, because it's based on what's already happened. So if you've been doing $500,000 in revenue last year, and you did 450 the year before that and 400 a year before that, and you pro forma that you're going to do 3 million in the next year, people are probably not necessarily going to believe you unless you have a really good way to explain why your business is going to be 6 times as big next year. Okay. So, right. Financial statements are critical because they are the foundation for your pro forma. So building accurate financial statements is just so essential to understanding your company's financial performance and being able to share that performance with folks outside. So why do we do financial statements? Of course, we're required to in order to pay taxes, but that's not the only reason. We can't tell how our business is doing unless we put them into generally accepted accounting formats, GAAP, principles followed. And they are so that we are privately held businesses. We're not required by law, like a publicly held business is, to share our financial data with anyone. But we have to be able to tell folks outside the business, banks, investors, taxing authorities, how we're doing. And in order to do that, we have very specific formats and rules that we follow to present our statements, our financials. So this very horrible slide, I apologize for it. I have tried 6 ways from Sunday to make this more palatable, and it's just not possible because this is a chart of accounts. So how does a financial statement get formed? It gets formed by organizing accounts. So think of accounts as buckets, and think of money as water. So when money comes into your company, it has to go into a bucket. It can't go, there's no drain. It's all buckets. Every penny has to be accounted for by putting it into a bucket. Now there are, let's just say, red buckets and yellow buckets. Red buckets are for the balance sheet. Yellow buckets are for the income statement. And they're very different. They show your business from 2 perspectives. And we're going to walk through what those are. Let's go back one more second. So each one of these accounts is one of those buckets. So we have a bucket for your checking account. We have a bucket for your accounts receivable. We have an inventory bucket. We have a computer equipment bucket. We have an accounts payable bucket. Okay, those are all balance sheet buckets. Then we have revenue, a revenue bucket. We have a cost of goods sold bucket. We have legal expense bucket. We have a utilities bucket. Those are all expenses. Those are income statement accounts. So we begin by having this chart, which names the account with a name, numbers the account. Every account has its own number. They're all unique. And a financial statement. Each account is assigned to a financial statement, either the balance sheet, the income statement, or the cash flow. Okay, so that's what your chart is. Everybody's got one. If you have it, there's one in your accounting system, whatever it is. If it's QuickBooks, it's easy to find. You go to company or lists, chart of accounts, and you click and you see them all.
And you usually do this once. So it's really, but getting it set up right, which I love that Laura worked with you to set up hers right. Getting it right at the beginning makes the rest of it so much easier.
It's true, but you only do this once is not true. Charts of accounts are restructured and rewritten all the time, especially, for example, I have a company right now that doubled their revenue in 1 year. And they doubled their revenue by establishing 3 new revenue streams. So those revenue streams didn't have buckets last year, but they do now. And so we rewrite the chart to establish both the revenue streams and the costs associated with those. However, we do not rewrite our chart every time something changes, and we do not rewrite our chart mid-year. We do it at the beginning of a year only, because it's very important to be able to compare financials across years. And if you change your chart, you can't compare apples to apples. And that produces challenges you do not want to endeavor to, you have to be very careful to manage those challenges. Okay. So again, 3 main financial statements: the balance sheet, the income statement, and the cash flow. And we're going to walk through each one. Okay, balance sheet. This is the financial statement that shows you what you have to work with. So I want to make a product, or I want to deliver a service. What do I have? I have cash. I have near cash, investments and accounts receivable. I have money that I owe people, accounts payable. I have inventory, things that I've already manufactured and are ready for sale. So assets, again, cash, amounts in bank accounts, amounts in short-term investments, meaning those that are going to be available to me within 364 days or less. Inventory, which is a non-current asset. Property, plant, and equipment. So if I have a building for my business and I own that building, that could be there. And then liabilities, which are demands against my assets. So accounts payable, I owe people money. So even though I have a bunch of money in my checking account. Some of it's promised to other people that I owe bills to. So that's a liability. I have payroll that has to be paid in 2 weeks. I have healthcare expenses that have to be paid next month. So those are all liabilities. And then the difference between assets and liabilities is my equity. That's a number that shows how much of my business belongs to me. So that's where if you take in outside investment, that's where you'll see it in capital. And if you are making money from your operation, so revenue minus expenses is a positive number, that's going to show up in retained earnings. I know I'm talking fast, so if anybody has questions, please jump in. No problem. This is a sample balance sheet.
Christine, may I? So I did have a question. I put it in the chat. I don't know if you're able to see them. I think the report is called the trial balance.
Yes.
And the combined, I still struggle with this. I actually have to do a Google sheet every month to see a combination of my profit and loss and my balance statement. Because I don't know who all knows this kind of stuff, but like, yeah, so I made an $800 car payment. Well, 300 of it went to interest, profit and loss. 500 of it went to the liability balance sheet. That is one thing I don't know how to do in QuickBooks is generate the trial balance so that I don't have to be putting these numbers in Google Sheets every week.
Actually, Glara, you're going to use your cash flow statement and it's going to solve the problem for you.
Okay.
We're going to get to that. That's the one that most people don't do because they get to the balance sheet and the income statement, they stop right there. But we're going to get that free. That's a great, you have really come along, my friend. Good for you. I'm proud of you. Okay, this is a balance sheet. Now let's go back. We didn't look at this yet. So again, assets on the right. So we have cash. We have short-term investments. We have accounts receivable. We have some inventory. We have some supplies. We have prepaids. So let's say it's April and we got a bill for next month's healthcare and we paid it this month because we had the money. So we paid it. It's not going to be used until next month. This is accrual accounting. We show it as a prepaid here, prepaid insurance, $1,500, but it will not hit the income statement until next month because we match for the period, revenue received in that period, the period being a month, and expenses against that revenue in that month. So this insurance isn't going to cover, it's not covering April, it's covering May. So next month there will be a transaction to move this insurance from the balance sheet to the income statement. Okay. And yes, you're welcome. So liabilities here we show, accounts payable, wages payable, interest payable, taxes that are due, warranty liability, someone returned something and we have to cover it. We had some bond financing, so we've got some bonds payable. The difference between those is shareholders' equity, stockholders' equity, which is $289,000, which is lovely. We have $110,000 in common stock, which was the amount of money that was put in to start the business. And then we have retained earnings. We've made some money doing this business. We don't have to talk about treasury stock. That's a 3-level course. But you can tell this is very important on a balance sheet. Assets always equal liabilities plus equity. Always. If you pull a balance sheet and those two numbers aren't the same, that is a problem and it needs to get fixed. Okay, income statement. Income statement is different. It shows revenue, money we got from selling our products or services, expenses, money that we spent this month to support the creation of that revenue, and the difference is either a profit or a loss. Okay, this is an example of an income statement. Very simple. $1 million in revenue for the year ending December 31st. Cost of goods sold, those are the direct costs to produce our product. This is a fabricating company, so they had to buy metal and they had to pay utilities and they have rent and labor, direct labor, people that are actually working in the fab shop. And so their gross profit is $800,000. Gross margin, which is very important, is 800,000 gross profit divided by $1 million in revenue. That's how you calculate that. Gross profit is always a dollar amount. Margin is always a percentage. Okay, operating expenses for this same period. Selling, general, and administrative below the line costs $357,700. Interest $20. Depreciation and amortization $5,200. Those are non-cash expenses representing the implicit use of depreciable assets for this year. So that amount reduces operating income, it reduces taxable income, but it does not require cash. And then we have interest income. We got some money from the money that we held. And so we have net earnings before taxes. And then we have net income, which is after tax. This is a very simple income statement. Okay, cash flow. Cash flow brings together elements of the balance sheet and the income statement to show you the cash impact of the changes that happened over a period. So for example, operating cash comes from your income statement. So this is the cash that you got from revenue, but it's less expenses. So you would take for this section, this comes from your income statement, and you look at your net income, and then you would add back non-cash expenses. So if the last example we had, they made $10,000 in net income, we add back their depreciation and amortization, which was $5,200, and we get operating cash of $10,500, $15,200. Investing is cash that results from the buying or selling of assets. So maybe we have a building that we own as a business, and we decide that we need a bigger building, so we're going to sell this one and buy a different one. Well, when we sell the one we have and we've owned it for 20 years, there'll be a profit on it probably, and there'll be cash from the sale. So that cash would go here. That would be an increase in cash from investing. If we then take some of that cash and buy another building, that would be a decrease in cash from that building. And it's the net of those that shows up in this blue tranche. Okay, then financing. Did we get cash from a loan? Or did we take in investment from an outside investor? Equity. So that's cash. If we borrowed on a line of credit, that's cash in. If we got a term loan, that's cash in. If an investor said, I'm going to invest in your business, and we closed that investment during this time period, that's equity investment. And then we add all of these up and we get the cash impact for the business. So in this case, for this company, they had net income of $79,000. They're adding back depreciation, which is non-cash, of $2,000. Then this is where the balance sheet comes in. So those first two numbers come from the income statement. Now we're going to go to the balance sheet and say, how did our net asset accounts change? Did accounts receivable go up or down? If accounts receivable went down, that produces cash. More people paid us than we invoiced. If inventory goes up, that costs us money because we put money into products and we put them in inventory. We didn't get any money for them yet. Inventory costs money. So inventory went up, that cost us cash. Accounts receivable went down, that created cash. And we add them all up and we get a net cash increase of $71,000 for the year. Okay, investing. We sold property or equipment, and we got $10,000 from that sale. We then paid $12,000 to purchase other equipment, so that costs us $12,000. So the net impact from investing is a negative $2,000. Then financing, we made a loan payment. So that costs us 5,500. So we add up the 71,000, the negative 2,000 and the negative 5,500, and we have a net increase of cash for this year of 63,500. Okay. So to obtain a line of credit, you will be required to provide a pro forma, typically 3-year. The current year plus 2. You base it on past performance. So you look at what did I do last year or the last 2 years by month. Pro formas are by month. You don't say to a bank, here's my annual no, you don't give them one number for the year. The first thing they'll ask is, great, in what month are you going to have all that revenue? Are the months the same? Do you have any seasonality? Seasonality is a business where you get more revenue in a certain time of year. So let's say I own a ski resort. I'm going to get a lot more money in January, February, March, and December than I am going to be in June, July, and August, unless I have some way to commercialize that mountain in the summer. Maybe I have a golf course up there too. Okay, then you use the pro forma to tell your story. The pro formas aren't, there is not one pro forma, there are always 3. Best case, worst case, and most likely. None of us has a crystal ball. None of us knows exactly what's going to happen next year and in 2 years and in 3 years. But we can make an educated guess based on what we did before and what our business strategy is. So if we plan to grow and we're taking steps to make that growth happen, then we're going to reflect that in the pro forma. We can grow organically, meaning do more of what we already do, or we could grow in a step function by acquiring another business or merging with one. So we decide what those scenarios are, but the most likely is the one that sort of threads the needle. I'm pretty sure this stuff can happen, has a high probability of happening, but it's not my pipe dream. That's best case. If every single domino falls the way I want it to, that's how good this is going to be. And then worst case is if everything goes wrong, I'm still going to do this.
And so the only thing I want to add to this very excellent explanation is don't be too daunted, because once you build it out once, you can then go play with those assumptions and create the multiple versions of it. So X% growth rate, this many staff members, and make those changes as in the worksheet. So it does all the calculating.
True. All true. Yes. So we start with the most likely. This is what I really think is going to happen. And then you punch it up for the best case and you cut it down for the worst case. It's been my experience that when people do this for the first time, some people tend to be sort of negative Nancy's, and they are very conservative and they don't put anything into it. And then others are big dreamers and they think it's, everything's going to work out and here's where we're going. So you have to sort of know yourself and give yourself more than one chance at it. And also, once you have created the pro forma, share it with somebody and see if they agree with that your assumptions are rational before you would share it with a bank or a lender. So again, the steps to create your pro forma. First, go to your chart of accounts. Determine if the chart accurately reflects your company. Now, what does that mean? How does your chart accurately reflect your company? First of all, when I take on a new client, the first thing I say is, okay, how many revenue streams do you have? I just had this conversation with someone and I have 3, this, and this. Okay. Does each revenue stream have its own revenue account in your chart? Usually the answer is no. So that's the first question I make. Then, when you have 3 revenue streams, the costs associated with each revenue stream are distinct. So if one of the revenue streams is rent from investment real estate, well, then the costs of maintaining that investment real estate have to have their own cost of goods sold section. If another revenue stream is from a retail store, then we have to have a retail cost of goods sold. What does it cost to maintain that product line? So each each revenue stream has to have its own bucket, and then it has to have a matching bucket in cost of goods sold that shows the costs incurred to maintain that revenue stream. Now, why do we need to do that? Because we need a gross margin on each revenue stream. That's how we plan. So if you throw everything into one bucket, one revenue line, one cost of goods sold line, you don't know how much you're making on this line or that line. It's not going to give you the information you need to pro forma your business accurately and to convince a bank you know what you're doing. Wait, let's go back. Let me make sure I covered everything there. So when you're beginning a pro forma, begin with your income statement. So take your income statement, pull it out of your accounting system, throw it into Excel, and then by month. And then so this is April. So this is April 21st. So let's say that you have the first quarter, January, February, March, you know what happened. Your books are closed for the end of March. So you have 3 months of this year, you have 12 months of last year. Let's start by projecting the rest of 2025. So what's April going to do? Well, April's half over, so you sort of know some of your revenue, but you don't have all your expenses because your month's not closed. And then you could look back at last year and say, well, in April, we did 8% of annual revenue. In May, we did 10% of annual revenue. In June, we did 12. So you start by saying, next year, I want to do this much revenue. Maybe it's the same as last year. Maybe it's last year plus 5% because you've at least got to cover inflation. Or you're planning on growth and we want to have a 20% growth rate or a 30% next year. You establish your annual revenue for next year, and then you distribute it across the months based on some methodology. That could be, when it's coming in because you have contracts, or it could be because you expect it to follow the same cadence as last year. And if so, just do the math, spread it out according to the same percentages as last year. But whatever you do, take notes. I put this much revenue in May because of this. I put this much in September because of this. Make little notes to yourself so that you know why you did what you did and you can defend it. Okay, so you pro forma the income statement for the current year plus 2 years in the future. And again, the goal is to show that, let's say your gross margin for 2024 was your net margin, your net income at the end of the day was 5% of revenue. Well, you want next year to be at least 6. And the goal is that your net income never be less than 10. A very viable business wants a 10% net margin. If you've got a really profitable business, it's going to be way more than 10. But if you've got a business that after all your expenses, after everything, you're still showing 10% at the bottom, you're viable. Did I lose anybody? I know I'm going fast.
I think we're doing good. And here's the thing. We're never going to be able to explain everything that you need to know about pro forma in the 5 minutes we have left. But I want to leave some time for questions. And I am going to share the worksheet with you, which will help you at least get jump started on it. So I think we should probably get through the last couple slides and then open it for questions.
Super. Okay. So again, go through your monthly income statement line by line. Look at each line and put a note column on the right-hand side and say to yourself, what makes this line change? So does this line change if revenue doubles? Does this line double too? Or does this line only change when the number of employees changes? Payroll taxes would be one of those. Or does this line change when the amount of real estate that we use doubles? Because you could lease a new building with 200 square feet additional space, which is a higher lease rate, but your revenue doesn't change. So it's not revenue changing or employees changing that causes that real estate number to go up. It's because we've signed a new lease for more space. So it's more space that made that change. Or is this 9 changing just because inflation is causing the number to change? Okay, so Gloria wants to know, where can we get affordable, free, and reliable benchmark information for our industry or business to compare it to? There's lots of online sources, and there's also the Department of Labor is a really good one. The Department of Labor, at least it used to, collects data every week and aggregates that data and publishes it. So that we know in America that if you have an NAICS code, that's 302, you can look at what other businesses with an NAICS code of 302 do, what their gross and net margins are. I hope that helps.
Thank you.
Sure. Okay, so then make a list of events that will impact your income statement in the future. Like, do you expect to hire anybody this year? Is anybody going to retire? Are you going to give employees raises? Are you going to change the rate that you work with contractors? Pretty sure your contractors are going to raise their rates every year. Do you still want to use them? If so, you're going to pay more. Is revenue going to grow because you're going to have new customers that you didn't have last year? Are you going to put together a new marketing campaign that's going to bring in new sales? Do you need to run your business more space? Do you need to buy a machine? Do you need to have a new website? What are the big initiatives for next year? Make a list of them along with what they will cost or the revenue that they will bring in. And you're estimating all this, but you're the owner, so you're going to have an educated guess. But remember who your audience is. So that's why you want 3 scenarios: best case, worst case, most likely. You want to always make notes. If you say revenue is going to go up 10%, why? Are you going to do more of what you're already doing? Are you going to get new customers? If so, how? Are you going to grow the relationship with existing customers? Are you going to acquire someone else and add on revenue? How are you going to make that revenue go up? Same thing with expenses, with every line. What are your initiatives that are going to change things? Okay, and when your pro forma by month for 3 years shows your business to be increasingly profitable with positive cash flow. Now that's that EBITDA. I don't know if everybody's familiar with that, but it stands for earnings before interest, taxes, depreciation, and amortization. It is a proxy for cash flow that is used in finance everywhere and by banks and by investors. And the reason that it's nice is because it's a good financial construct, is because everybody can evaluate EBITDA the same way. So no matter what your business is, you can have this same number and you can add it up as soon as your financials are available. You can do the math, and so can your investors and your banks, and they can compare your company to other companies based on something that is the same. So they're not, it's a proxy for cash flow that's quickly calculated, and they can compare companies with it. All right. Once I'm ready, who do I get a line of credit from? You start with whoever you've been doing business with, whatever bank you've been doing business with. Now, if you don't, let's say you start with, you've got an operating account, because if you have a business, you have to have one. You have a business checking account. Who do you have it with? Whoever that is, hopefully you find a reason to go in there every couple of weeks. And when you go, you dress up and you start to let people in that bank know who you are. Or you could just say, you could call your bank and say, hey, I'm a business customer. I'd like to talk to a business banker. I'd like to have coffee with them once a quarter. You want to become known to your bank or another bank, the bank that you aspire to work with. But banks and lending is a relationship endeavor. It makes a lot of sense for them to know that you are honest, kind, good, hardworking, intelligent. You know, when you say something, you're going to keep your word. That's how you get a line of credit. You don't want to be a stranger when you go to a bank. And you certainly do not want to do this online without knowing a human being. Human beings make these decisions, and you don't want a computer doing it. Okay, community development financial institutions in your area. We are lucky enough to have them here. Again, Bridgeway Capital is a great one. Yeah, do not do this online. This is a human being, a relationship endeavor. All right, we're done. I'm ready for questions.
I will tell you that that last slide was one that Christine insisted that I put in because it is easy to just Google, where can I get a line of credit? But do not go there, at least not first. All right, Laura, you're still here. Why don't you ask your question now? Is it too late?
Yeah, no, it's not. Yeah, so I actually have a great relationship with my bank. I work with Huntington, and